When a C corporation is capitalized, someone is putting in cash, property, or even services and getting stock back. Most of the time, the corporation doesn't pick up income just because it received capital. Your job on the EA exam is to separate cash or property contributions, stock issued for services, and special rules like Section 351 and debt workouts. Start with the simplest case, shareholder cash for stock. That's basically a purchase of stock. The shareholder recognizes no gain, and their stock basis equals the cash contributed. If property is contributed, you're usually thinking about basis and whether Section 351 applies. But the big theme is, capital contributions generally aren't taxable income to the corporation. Stock for services is the trap. Services are not property for Section 351. If you receive stock for services, you have compensation income equal to the stock's fair market value. That same fair market value becomes your basis in the stock. On the exam, they love mixing property and services in one deal to see if you incorrectly make the whole exchange tax-free. Now the weird one, non-shareholder contributions to capital. If someone other than a shareholder, like a city or a developer, gives property to the corporation to induce it to locate there, the corporation generally treats it as a capital contribution. But the basis rule is harsh. The corporation's basis in that contributed property is zero. EA exam tip: non-shareholder is your cue for zero basis. Section 351 is the main non-recognition rule for incorporating property. If one or more transferors contribute property to a corporation solely for its stock, and immediately after the exchange, the transferors control the corporation, then no gain is recognized on the property transfer. Control means at least 80% of voting power and at least 80% of each non-voting class. Miss 80%, and the transfer becomes taxable. Last, watch what happens when a corporation uses its own stock to settle a debt. This is not a Section 351 situation. If the debt is bigger than the fair market value of the stock issued, the corporation has cancellation of debt income for the difference. Think, debt minus stock FMV equals taxable income to the corporation. It's a classic distressed company fact pattern. Diana and Kara transfer property with a basis of $80,000 to a corporation in exchange for 75% of the corporation's stock. The remaining 25% is held by another unrelated individual. The stock is worth $140,000 on the transfer date. How much gain, if any, must Diana and Kara and/or the corporation recognize? Think about it. The correct answer is, Diana and Kara recognize $60,000 of gain, and the corporation recognizes zero. Section 351 fails because the transferors only own 75% after the exchange, and control requires 80%, so the transfer is taxable to them. Fair market value of 140 minus basis of 80 equals 60. The tempting wrong choice is zero gain, because people forget the 80% control test. Marisol is a CPA. She transfers a building worth $48,000 and also provides accounting services worth $4,000 to a corporation in exchange for stock worth $52,000. Right after the exchange, she owns 80% of the corporation. What's the correct statement about this transaction? Think about it. The correct answer is that she must recognize $4,000 of ordinary income for the services, and no gain is recognized on the property transfer. Services are not property for Section 351, so the stock received for services is taxable compensation at fair market value. But the building transfer can qualify under Section 351 because she has 80% control immediately after the exchange. A tempting wrong answer is calling the whole thing a qualified 351 exchange.